Hello and welcome everyone to this weekly market recap. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and I'm going to be taking a look over the last week. So just to clarify, just from the Thursday open of last week through the close today, and it is Wednesday, so I'm recording this just a day early, but Wednesday, October 23rd. It's been kind of an interesting week. We haven't had a whole lot of economic reports. We did get the retail sales out last week, which was better than expected. This week really hasn't been a whole lot in the way of economic reports. Earnings reports, though, are starting to kick in, and we do have a 10-year Treasury yield that has been very stubborn and continue moving to the upside, taking out key resistance at about 4.15% and continue to push higher. And I think that in turn has led to a little bit of nervousness in U.S. stocks. Taking a look, though, at what's transpired over the last week. Again, here is a chart list where I like to look at the 11 sectors and then also 6 major indices, including the Dow Jones, the S&P 500, the NASDAQ 100, small cap, IWM, the mid cap, MDY, and then also transports. So it's those 6 along with 11 sectors. And you can see over the last week, utilities and technology have been at the top. It's kind of a weird combination, but both of those groups have been close to the flat line. You can see all 17 are down over the last week. So we have seen a little bit of weakness, a little bit of a pullback, which overall I think is pretty good. We're in a very bearish historical period. This is the worst week of the year historically, starting back on, beginning of this week through the end of the week. So we'll see what happens from there. Starting next week, we go into the most bullish period of the year. So again, kind of going from cold water to hot water, however you want to look at it. But the overall market does tend to be weak this week, and then we tend to move higher starting next week. But looking back at this list, if we go all the way down to the bottom, you'll see on the bottom, IWM, small cap stocks, transportation stocks, move up a couple more spots. There's your mid cap index. So areas that were leading the market when we chatted last week have flipped and are now lagging the market. So we've got this rotation that keeps going back and forth. Market can't really make up its mind. I do believe that the overall rotation favors areas like the financials, like the transports, like small caps. But again, what I'm thinking is short-term rates will continue to come down. We'll hear more and more as we get closer to the next Fed meeting from many of the Fed officials, but they were pretty clear a month ago that they wanted to switch from a more hawkish tone to a more dovish tone when looking at the market and looking at the economy. And so that's kind of what I'm banking on when I make some of these calls that I make. I'm looking for short-term rates to continue to move down. Maybe not at the next meeting, but I do think over time, interest rates, the short-term rates will come down. Longer term, though, as I mentioned at the top of the show, the 10-year Treasury yield continues to push higher. And I do think that's putting a little bit of selling pressure on U.S. stocks. But let's move on. Let's take a look at a couple of the key areas. So obviously the S&P 500 just recently putting in a new high, but you can see over the last week, we have pulled back. These last 5 days, we've gone back down. We've tested the 20-day moving average. The good news from Wednesday is we traded below the 20-day moving average intraday, but managed to come back up and hold it into the close, which I thought was a positive. One thing I continue to watch and I continue to talk about, harp on, whatever, is the extreme short-term bullishness in the options world. Still a lot of folks trading call options versus puts. And because sentiment tends to be kind of the opposite of what happens, normally the masses get it wrong in the near term and we see a reversal. If you look at this 5-day moving average of the equity-only put-call ratio, these last 2 readings, these last 2 lows have been down at around 0.51, 0.52, which historically has marked tops, short-term tops in the S&P 500. If we go back and we look, back in August, this low at 0.55 pretty much marked a short-term top in the market. We end up going down for the next couple of weeks. If we go back into July, mid-July, these 2 lows marked a top and we ended up going down for a couple of weeks. If we even go back here into mid-May, we had a low down at 0.55 and we saw not a lot of selling, but we did see a pullback off of that level. So here we are with even more bullish readings, more complacency, and yet the market just seems to want to continue higher. But again, we did pull back here today. We've been pulling back the last couple of days, kind of rolling over a little bit. It's going to be interesting to see whether things pick up from here. I am going to talk about Tesla, though, in a couple of minutes. They did report recently, and the stock is really being rewarded after hours, up to the tune of about 10% the last time I looked. But again, we'll check that out in just a little bit. Utilities. So we talked about the groups that were leading the market: utilities, technology, energy. So let's talk about utilities. I see a cup and a handle. So beautiful move up, down, back up, slightly higher high. We've been going sideways, holding that 20-day moving average. It looks like utilities want to break to the upside. Technology didn't quite get up to that July high, but got pretty close. Now we're kind of backing off almost like in a handle, similar to the XLU. Went below the 20-day moving average intraday on Wednesday, only to come back up and hold that key moving average at the close. So that was good. Energy. Energy is an interesting animal because it does like to track crude oil prices. Here's energy and what energy's been doing since back at the top in April. Look at what crude oil prices are doing. Same thing. And so I pulled up this correlation coefficient to show you that when you look at the two of these, when you look at crude oil prices and you look at energy, the XLE, typically what we see is movement in the same direction. We get positive correlation. And this positive correlation goes back, I mean, we could make this weekly and go back, let's go back 10 years. I think you're going to see pretty much the exact same thing. You got energy going sideways, crude oil going sideways. We have the big drop in crude, big drop in the XLE. We rebound on crude, we rebound on the XLE. Now we have seen a little bit, we did go negative, you can see back at the end of 2022. But other than that, we have been staying in pretty positive territory over the course of the last 10 years, meaning that, again, even not just short term, but long term, energy tends to do whatever crude oil prices are doing. Crude oil prices have been hovering down around that $70 a barrel here for the last couple of weeks. We've got really significant support at about 65. We want to hold that level. If we fail, then I would suspect that the XLE is going to come down as well. But at least for now, the crude oil price is holding on to support. XLE trying to hold on to support as well. All right, had a question come in about the gold miners and the fact that the miners look really good right now. When you look at the absolute price chart, I have no problems with the miners. They continue to push higher. Looks like they're just making a key breakout above the 2020 high. When you look at gold prices continuing to rise, all of that looks pretty good. And you can see as gold prices go up, the miners have been going up. And here's another correlation. This is a 10-year correlation to take a look at miners versus gold. And I would say whatever gold does, we tend to see that same type of behavior in the miners. So it's not shocking to see gold going higher and the miners going higher. Now, I was not a big fan and have not been a big fan and still not a big fan of gold, but I can recognize an uptrend when I see one. Gold continues to trend higher here in 2024. I think as long as this uptrend remains in play, we're fine. Stay long, trade gold, that's fine. If this starts to roll over, you want to be careful though. Let's move on to this next chart with gold. So here's that monthly chart on gold going back 30 years. And what I want to say is when the dollar is going up, gold typically goes down, and especially gold relative to the S&P 500. So from 1995 to 2001, we had the dollar rising and we had gold underperforming. From 2001 to 2008, we had the dollar falling and we had gold outperforming. Then we went through this period for 2 or 3 years where we weren't quite sure which way we were going. And then the dollar broke back to the upside since 2011. And look at the relative strength of gold versus the S&P 500 since 2011. It continues to trade down. Now, if you look really closely here in 2024, you'll see that gold has actually been outperforming. But look at the big picture. The big picture is that gold is not a good performer relative to the S&P 500 as long as this uptrend remains in play. And the dollar, this is a monthly chart, so this goes back to September 30th. This is not showing us what the dollar's been doing in October. So let me show you what the dollar's been doing in October. Down here on the bottom, we bottomed at the end of September, and the dollar is going straight up in the month of October. So I think we have to be careful and recognize that. Currently, we've got the dollar going up. We've also got gold going up, which is unusual. But the key that I look for in trying to determine which way the dollar is going to go is I like to look at interest rates, the 10-year Treasury yield in the US versus Germany. So it used to be back in the 1980s when I was in school, in college, you pretty much just looked at what was going on in the US. But we're a much more global economy now than we were 30 years ago, 40 years ago. And so you need to look at what's going on among yields in the US versus other countries around the world. And the one that I like to follow the closest, because the correlation is so tight between the two countries, is Germany, US versus Germany. So this is a chart showing you the difference in US yields versus German yields, the 10-year. And notice when we were going down, when the yields were going down, the US versus Germany, the dollar for the most part was going down. We had this spike. What'd the dollar do? The dollar spiked. Then we had this 5-6 month downtrend. So yields in the US were either going up less fast than Germany when rates were going up, or US rates were going down quicker to the downside than they were in Germany. And during that period, look at what the dollar did. The dollar went down. But since the middle part of September, we've now started turning back to the upside. And look at what the dollar is doing. The dollar is following suit back to the upside. So keep an eye on the 10-year Treasury yield in the US versus Germany, because that gives us a pretty good clue about the dollar. And then the dollar gives us a clue about energy and gold. Check out this CRB index. Here's the CRB index for the last year. Been going straight down. So as the dollar continues to pick up steam and remains in a long-term uptrend, the commodity index is actually making it very difficult, or is having a difficult period trying to outperform the S&P 500. Anyway, I just wanted to show you some of those relationships. Hopefully they make sense to you. If not, use whatever works for you. But these are some of the charts I think that are really important to me. All right. For those of you who are interested, we do have a free newsletter over at EarningsBeats.com. So if you go over to EarningsBeats.com, both plural, EarningsBeats, scroll down, you'll see an area where you can sign up for our free newsletter. Name and email address is all it takes. The newsletter comes out Mondays and Wednesdays, usually before the market opens. And I talk about lots of different things: earnings gaps, relative strength, sentiment, trend lines, moving averages, all the different things, price breakouts, all the things that you would expect in terms of technical analysis and various intermarket relationships and so forth. So make sure you check that out. If you are on your mobile device, there's a screen now up where you can use your mobile device to scan the QR code. That also will take you to a page where you can sign up on your mobile device to our EB Digest newsletter as well. All right, let's get back to a few things here in the market before we wrap up. I wanted to show you the financials. Financials, in my opinion, continue to be very strong. You can see this triple top breakout that we made in mid-October, maybe the second week of October. We've pulled back from recent highs, but still well above the 20-day moving average. We're seeing a lot of our key indices, the S&P 500, the NASDAQ, technology, all those areas on Wednesday tested their 20-day moving average, went below, and then came back up. Financials haven't even tested that 20-day yet. They continue to show really excellent relative strength. And if you notice the weakness the last 3 days, look at the volume drop off on the XLF. So I think financials remain a very, very strong area. I still like the banks. So I wanted to bring up the banks here. You can see the triple top on banks. We made a breakout. Banks are still sitting near the high. So we have had a little bit of a pullback, and we've seen it on lesser volume. But banks, in my opinion, still look very strong and look like they're ready to push to new highs. And I'm expecting banks to continue to perform well in Q4. All right. One other thing that we like to do at EarningsBeats is we put together these upcoming earnings chart lists. And the reason we do this is that once the stock market opens after these earnings come out, we can put this in summary form and we can see exactly what every company has done after reporting its earnings. We get market reactions and we can look at all of them at once rather than trying to go through one company at a time to see what kind of market reaction we're getting. But what I did here is I actually took this list for today after the market closed. So this is all the companies reporting today after the bell. And I ignored the ones that'll be reporting tomorrow morning. I'm only looking at the ones this afternoon. And I went through and I looked at their reactions. And the companies that are getting positive reactions start with the number 0. The companies that were getting negative reactions all start with the number 1. So IBM, I can give you some numbers here. Just bear with me one second. So let me just run through some of these numbers with you after hours today. IBM down 2.5%, down about $5 after they reported their numbers. ServiceNow down about 1%, so down a little bit there. O'Reilly, ORLY, down $34 or almost 3%. NEM, which is Newmont Corporation, down almost 5% after hours. United Rentals, URI, down 3% after hours. ICLR really getting hit hard, down 17% after hours. That's $48. The stock was already downtrending, and now we know why. It's been downtrending for the last few months. And the quarter, obviously, the market didn't like the quarter that was just reported, and we see ICLR down another 17%. Getting to the ones that did well today, though, I want to walk you through Tesla, because Tesla, let me show you, we were up 9% there, but now we are up 11.6%, $25 almost from 213. We had our live trading room today earlier, and we talked a little bit about Tesla. I had a couple folks ask me what I thought going into this earnings report, and I thought it was interesting. I'm going to pull up this chart on Tesla. We're going to wrap up with this, by the way. But on this Tesla chart, remember a couple of weeks ago, we had the robo-taxi event, and it was just kind of a dud for Tesla. Tesla, you can see the stock gap down, and it just hasn't been performing very well. I mean, mostly just trading sideways. You can see very, very little in the way of candle bodies, meaning that there's, we've been closing pretty close to the open almost every day. So we did get that initial gap down, but not really a whole lot since then. And I'm kind of looking at resistance being up at 265 and support around 190. So Tesla was trading a little bit closer to support. So what I said earlier in our live trading room was that I thought, if I had to place a trade on Tesla, and I didn't have to, and I didn't, but if I had to, I would have gone long. And I thought there was a lot more room to the upside. I think we've tried to make a couple of pretty decent moves. I also like this AD line on Tesla and the fact that it appears to be accumulated, even though the price hasn't really been going anywhere. Following these uptrends, we've been seeing downtrends. Haven't been able to get through 265 all year. I mean, this 265 high over here, this dates back to December of last year. So it's been a while trying to get through that level. And if we can get through 265 in time, I think that's a very, very bullish signal for Tesla. And I don't know where we're going to open tomorrow, but right now looks like we're on the verge of maybe closing this gap, which was right at about 238 right before that robo taxi event. So I think 238 is going to be a key area short term. If we can get through that, I think Tesla has a chance to make that run to 265. So that's basically what I had. We've got a lot more earnings coming out the rest of this week and into next week. We're going to start seeing the likes of Apple, Microsoft. We won't get NVIDIA until about the third week of November. But Meta platforms will be out. We'll be seeing Amazon and Google. A lot of big reports coming out. We'll see how those go and whether or not we can make another breakout to a new high. But I do think once we get through this week, history will then start to align more with the bulls. I think we'll have a chance to do a little bit more. But if you want to follow me on, at Stockcharts or all the other places where you can track me down, simply use, again, your mobile device and scan the QR code on your screen, and that'll take you to a registration or a landing page where you can find all the different areas where you can follow us at EarningsBeats. So That's essentially what I've got. I mean, we haven't really had a whole lot of economic reports. We do have another jobs report coming up next week. So that's going to be very interesting as we open up November. Of course, we've got the 10-year Treasury yield. We have to keep following that. I think that's been providing some clues for the market recently as that 10-year Treasury yield's been climbing. It's really put it, a kibosh on many areas in the stock market, including home construction and some other interest sensitive areas. So if we get that pullback in the 10-year Treasury yield, we start to see that roll over. I think that will create some opportunities just as we move into the most bullish period of the year. Anyway, that's all I have for today. I appreciate you tuning in. Wish you a lot of luck the rest of the week and have a great weekend. And I'll be back next Thursday or next Wednesday. Have a great week, everybody. Happy trading.